Welcome back to the Deep Dive. This is the show where we take your sources, your research, and we really just try to cut through the noise and get to what matters. And our mission today is all about looking forward. We're trying to find these brilliant, high-growth companies that are really set up for long-term returns. So the premise here, from the sources you've shared, is that growth stocks have been the engine of the market for, what, more than a decade now?
Oh, easily.
And in a bull market, that's not a trend that just goes away, right? It actually gets more focused on the companies building, I guess, the next generation of our economy.
Exactly. And the sources you provided, they're fantastic because they show this diversification and growth. We're looking at momentum across three totally different sectors. We're not just looking for who's big right now, but who has these durable competitive advantages, these moats,
Right, the moats.
whether they're technical or, operational. So we'll get into two huge tech players using AI in very different ways. And then one consumer story that's just, well, it's executing an old school expansion model perfectly.
Okay, let's unpack this. I think we have to start with the company that has basically become synonymous with AI. Your sources call it the ultimate growth stock, and I think that's fair. NVIDIA.
It's really hard to overstate the speed of their growth. This isn't just growth, it's hyper-acceleration.
Yeah,
Especially for a company of this sheer size.
absolutely. When you look at the financials, the pace is just, it's staggering. So last quarter, NVIDIA grew revenue a massive 62% year over year. But I mean, that's only half the story.
Right.
That revenue figure was around $57 billion. Just 2 years ago, it was $18.1 billion. So it's more than tripled in 2 years.
Just wrap your head around that for a second.
For a company at that market cap, that kind of acceleration is, it's almost unheard of. But let's get into the why. Why did their chip, the GPU, become the absolute foundation for AI?
Well, the key is really how a GPU is different from a CPU, a standard processor.
Yep.
A CPU is designed for sequential tasks, one after the other, really fast, like a single, super efficient bank teller. But deep learning, it needs to run thousands, even millions of calculations at the same time, in parallel.
Testing all the possibilities in one.
Exactly. And NVIDIA's GPUs were built for that, for parallel processing. So instead of one bank teller, you have this huge army of tellers all working at once. That architecture is just perfect for them heavy lifting AI models need.
So they had the perfect hardware for this exact moment in time.
Yeah.
But the sources are really clear that the hardware alone, that's not the real moat. It's the software, right?
Right.
It's CUDA.
Precisely. The hardware is what gets them in the door. CUDA is what locks it behind them. It's this proprietary software platform, an ecosystem they've been building for decades.
An ecosystem of what, exactly?
It's, optimization libraries and code that tells the GPUs how to run AI workloads as efficiently as possible. For a developer to switch, they don't just buy new chips.
They lose all that work.
They lose thousands of hours of expertise built on CUD. They're effectively resetting the clock to zero. That friction is the real competitive advantage.
But the sources also point out that competition is heating up. I mean, you're seeing these application-specific integrated circuits.
Right.
The ASICs, that's a real threat, isn't it?
It is. It's a critical question. An ASIC is a chip that's pre-programmed for one specific task, so it can be super efficient for something repetitive.
But that's the catch, right? Repetitive.
That's the catch. The world of AI is changing every 6 months. If you bet on an ASIC, you're locking in today's tech. A GPU and CUDA gives you the flexibility for whatever AI model comes next. And the market is valuing that flexibility very, very highly.
And we can't ignore the supply chain part of this, which your notes highlight.
Oh, that's huge. NVIDIA's execution is not just about design, it's about manufacturing muscle. They've locked up huge amounts of capacity at the big chip fags, like TSMC.
So while everyone else is scrambling for supply,
They've already got their orders in for the long term. That gives them a massive leg up on any smaller competitor trying to break into the market.
it's a brilliant move, but it also creates, a single point of failure risk. Relying so heavily on just a few global manufacturers, it's something investors have to weigh.
Absolutely. It's a story of incredible technical dominance, but it definitely carries that structural supply risk.
Okay, so let's pivot now to our second player here, Meta Platforms. If NVIDIA is, as you said, selling the picks and shovels for the AI gold rush,
Then Meta is using AI to get more of the gold out of the ground.
that's a great way to put it. And what's so interesting here is how AI is driving revenue acceleration for a company that's already, enormous.
Yeah, you'd expect growth to slow down at this scale, but with Meta, it's actually doing the opposite.
The numbers totally back that up. Last quarter, revenue growth hit 26% year over year. That's up from 22% in Q2, which was up from 16% in Q1. The momentum is it's undeniable.
And this acceleration is, well, it's a direct result of AI improving two core things at once. First, it makes the content you see more personal.
So you stay on the app longer.
You stay longer, which creates more ad inventory for them to sell. But second, and this is probably more important, AI is making the ads themselves better for businesses. The targeting is sharper.
So when advertisers get a better return, they're willing to spend more.
They spend more money. Exactly.
And we have the data on this. It's a perfect storm. Ad impressions, the number of ads shown, went up 14% last quarter. At the same time, the average price per ad went up 10%.
And that's the key metric.
Having volume and price go up at the same time is incredibly rare. Usually more volume pushes prices down. This tells you they have some serious market power.
It does. It tells you businesses feel like they have to be there and they're willing to pay a premium for the performance they're getting.
But we have to talk about the cost side of things. I mean, Meta is spending billions on Reality Labs, the whole metaverse concept. That's a huge drag on their profits.
It is a massive drag. But the sources argue, and I think it's a strong argument, that the AI-driven efficiency in their core business is so powerful right now.
It's basically paying for the whole bet.
It's funding the entire metaverse project while still accelerating their core profit. It's a really interesting balancing act that they seem to be pulling off.
And they have more in the pipeline, right? They're these huge new revenue streams that are just starting.
Right, that's their next act. They're just beginning to monetize WhatsApp, which is, used by billions of people. And they're building out Threads, their newer social platform. So the runway for growth looks pretty long.
Okay, so we've talked a lot about these digital moats built on silicon and software. But your sources rightly point out that sometimes growth is built on something a lot more tangible, on asphalt and customer loyalty.
Yes, exactly.
So let's make I think, a refreshing shift over to the consumer space and talk about Dutch Bros.
Dutch Bros is just such a standout story because their strategy is so simple and repeatable. It's classic retail executed at an incredible speed.
What's the strategy?
It's two parts. Maximize your same store sales growth, so get more out of the shops you have, and at the same time, execute this incredibly aggressive physical store expansion.
And they are backing that strategy with some serious numbers. Last quarter, revenue was up 25% year over year to about $423 million. And their comparable restaurant sales,
The hardest metric to maintain.
right, it rose 5.7% overall in the third quarter.
And what's really amazing about that 5.7% number is that 4.7% of it came purely from more customer transactions.
So it's not just price hikes, it's more people coming more often.
It's just more people coming through the door, which tells you the product is strong and the loyalty is really, really high.
But why are they getting that loyalty when so many established coffee chains are struggling? It can't just be mobile ordering, can it?
No, the sources suggest there's something else, a qualitative difference. They've built this really energetic local brand culture. They call it Dutch Love.
Right.
And their product is highly customizable, which really appeals to Gen Z. It's a high-touch service model that builds this strong local following, and that translates directly into how often people visit.
And that strong local performance is what gives them the confidence for part two of the strategy, the long runway of expansion.
And that's the most exciting part for a long-term investor. Just think about their footprint. They have fewer than 1,100 shops right now.
Which sounds like a lot,
But their goals are massive. They're planning for more than 2,000 shops by 2029, and their long-term goal is 7,000 shops across the country.
and that 7,000 number makes the growth path so tangible. Because they're only in 24 states right now. They started in Oregon, and they're just gradually moving east. The majority of the country is still untapped for them.
It's a very clear real estate-driven growth plan, and they're adding new ways to grow within those stores, too. They're rolling out hot food items now.
Like breakfast sandwiches, things like that.
Exactly. They're in about 3/4 of the stores now, and that's a huge move to get people to visit outside of the morning coffee rush. It could really increase how much people spend each time they visit.
So if we step back and we try to connect the dots across these three, radically different companies, what's the key takeaway here for you, the listener, about this kind of high-velocity growth?
I think it's the repeatability of their competitive advantage. All three are showing this incredible growth, but it's fueled by moats that are clear and scalable.
Right.
For NVIDIA, it's that technical lock-in with their software. For Meta, it's the market power you see when they can raise ad prices and volume at the same time.
And for Dutch Bros, it's the ability to just replicate a successful culture-driven store in a new city over and over again.
Exactly, execution power.
And that's where this all becomes actionable in knowledge, right?
Huh?
Because we've looked at three very different risk profiles. NVIDIA has supply chain risk and, high valuation. Meta has the huge cost of reality labs and regulatory pressure.
Well, for Dutch Bros, the risk is all about execution. Can they keep that special culture that Dutch love alive when they open store number 5,000 in a market that's totally different from their home turf?
A completely different culture.
And this brings up a really important question for you to think about when you're looking at any growth stock. How crucial is a defined multi-decade target like Dutch Bros' very tangible 7,000 shop goal versus a technical lock-in like NVIDIA's CUDA?
Hmm.
Both models promise long-term value, but they demand, well, completely different kinds of patience and scrutiny from an investor. So the question is, which kind of risk are you more comfortable with?
That is the perfect final challenge. Thank you for sharing these sources and letting us take this deep dive. We hope this gives you a much clearer, more nuanced view of the momentum players shaping the market today.
It's always a pleasure to really dig into the data behind the headlines. Until next time, keep digging into those numbers.